Oh, sorry. Go ahead, Rich.
No, I was just going to say happy Friday to our live audience. Rich Swerbinsky with the Mortgage Collaborative here once again with the Rundown with Rob and Rich. We just started broadcasting live. We'll give everybody a moment or so to get logged on and we'll go ahead and get started. Sorry, Rob, go ahead.
I was going to say I was just in Denver at I was there for various reasons, but the Colorado Mortgage Lenders Association meeting was going on in the Denver tech area. And it was a good bunch of folks and looked like a decent program and so forth. It was very well attended. And it was hard for me to tell if the general optimism was due to general optimism or the fact that they were just happy to be back in person. I tend to think that the mood was because they were back in person after some absence, but it was nice to see folks. And I wanted to give a special tip of the hat to Michelle Burke, who took the time to come say hi. And she's with Stera Credit Union there in Colorado. So Michelle, if you're, she had some very nice things to say about me. She didn't have anything good to say about you, Rich, but she said some nice things about me. So I thought I would mention that.
Yeah, they recently joined. I've known Michelle used to be at Lake Michigan Credit Union, and now at Wistera, which is a great credit union out in the Colorado area. So
Michelle has some very nice things to say. Hi, Michelle. And also, you'll notice that I am not wearing a coat, a sports jacket. I wanted to wear my proof that I went to the Masters one year.
Are you a golf fan? Do you play golf? We've never talked about this. No, neither.
No, I always had trouble with the anthill after the windmill, and so I just as a child I was, it was no good from there on out. Do you play golf, Rich?
Of course I hate to, but I will if I have to. I'm one of those guys. Like I worked for banks for a lot of years, so I used to have to do the stuffy banker golf outings, and I think it ruined golf for me. So now I play I play my own ball around a couple times a year. I'll play in scrambles and stuff like that. But I like to bet on golf. So
what about what's the bowling league action like where you are? Pretty strong?
In the winter, it's strong in Cleveland. There's not a lot else to do in Jan and February. I'm not a bowling league guy, but I have some buddies that do it. So fair amount of that here. So
anyway, so I went 1 year. I had to buy the shirt, and it was a very good experience. I went with a fellow named Tom Bird, who may or may not be on the call. And I guess that's an obvious statement, may or may not be, but Tom, we had a good time. It's a good event. If you ever get a chance to go, even if you don't golf, it's a good event. But we're digressing away from the topics you probably want to talk about on this call.
Let's get into it. Happy Friday, everyone. Rich Swerbinsky with the Mortgage Collaborative here with the Rundown with Rob and Rich. Take you into the weekend by going through all the latest and greatest in the mortgage industry. And as always, pleased to be joined by my co-host, Rob Krisman. Rob, good to see you. And where are you?
See you too.
What is that in the back? You're kind of blurry. You look like Max Headroom.
I am, yesterday I was in Denver. Today I am in Northern California in a little town called Novato, which is north of San Francisco, north of the Golden Gate Bridge, about 20, 25 minutes north of the Golden Gate.
There you go.
Those are just California foothills.
California,
drought-stricken California behind me.
You just randomly wandering through a field on a Friday afternoon, and
I'll be sure to check for ticks after we're done here.
Excellent. Well,
maybe during our call. I don't know. Things lag.
All right. Well, let's get into it. And let's start the rate climate. What the hell is going on? It was one of our co-hosts a couple months ago, I remember, asked you and I to predict how high, what the apex of the 10-year treasury yield would be in 2022. We both said somewhere around 250, 260 basis points. 272 on the 10-year, went up 40 basis points this week. We got 30-year fixed rates that are in the low to mid fives. This is the quickest ascent for 30-year fixed rates since the year I graduated high school, 1994.
1994. 1994. Yeah, it's crazy. Crazy, I tell you. We all knew rates were going to go up. We didn't know it was going to be a violent knee-jerk reaction to the various things that are going on out there, not the least of which is the inflation caused by Russia attacking Ukraine, which we've talked about. But frankly, the Federal Reserve is definitely caught off guard. The yield curve, which has been all over the map, flattened, inverted for a little bit, flattened, steepened a little bit. And so it's nuts out there. And like I said, we all knew rates were going to go up. We knew that 30-year mortgage rates weren't going to be 2 7/8 for forever, but it's the speed of which the rates have gone up and the economic news that just keeps coming our way. Like I said, I was in Denver this week, flew in and out of Oakland. The parking lot was full. The Oakland airport was full. The Denver airport full. I mean, it was crazy. You go to a restaurant, went out a couple times in Denver, very busy. The economy, despite how much it costs to eat out or how much it costs to buy a gallon of gas, people are out there, and they're buying things and they're eating out and they're traveling and so forth. And I think that it really hasn't, sunk in just how much this is going to cost us in the long run. Because right now, I think people are just happy to be out. Supposedly, mask mandate on airplanes will be lifted or is expected to be lifted April 18th. That'll be nice not to have to wear a mask if you don't want to on an airplane. But I think there continues to be, heading into late spring here and early summer, this pent-up demand for goods and services that are out there. And if you look at the unemployment rate, 3 something, non-farm payroll, jobless claims, the U.S. economy is churning despite the rise in inflation, despite the rise in interest rates. But at some point, interest rates will start to have an impact. They are already having a tremendous impact on lenders. And as I said earlier, the mood at the Denver event, the CMLA event, the mood was very good. It was hard to tell whether that was optimism about the business climate or just people were glad to see each other. I'm pretty sure it was people glad to see each other, because right now, a lot of lenders, when I've been talking to loan officers around the country, just informally, their business is down 40, 50, 60%. And when you look at the weekly applications produced by the MBA, the numbers aren't good. It continues to go down. And once again, we knew that we were going to see refi burnout. People, once they get into the twos, they're not going to want to refinance very quickly. So we are seeing that in spades. And also the lenders are saying, oh my gosh, rates are now in the fives. What do we have to offer these consumers, these borrowers that we, put into these great mortgage rates? What do we have to offer them in terms of seconds, HELOCs, other products? And I'll tell you, credit unions like Westera with Michelle Burke, or banks, have the inside track on some of these products where people want to pay off that 15% credit card, and so will avail themselves to some of these bank and credit union products. So we're already seeing that out there. So independent mortgage banks, of course, are hanging their hat on the purchase business. We'll see what happens heading into the summer. I don't think, as you and I have talked about ad nauseum, there's a lot of there's no inventory out there. And so we're waiting for the purchase business to pick up, but it's not going to pick up unless there's inventory to buy. So not a great time to be in the lending environment necessarily, but the mood is still good and there is still business to be had, especially with cash out refis. What are you hearing out there among the members?
It's a weird climate, and I just went out for dinner and drinks. At some meetings in Columbus, and real smart independent mortgage bank member of ours had a chance to spend some time with him, and he's like the prototypical TMC member. Independent mortgage bank, $500 million, a little bit more than that a year in annual production, and it's a weird climate right now. It's ops staff is the type of company that's not going to just be laying people off every time the wind sways. So you got kind of a nervous ops staff, you got some nervous salespeople, because you can't. It's in the news everywhere, right? Home values, rates, everything. It's hard to get away from it. And then you got this recruiting climate right now where everybody's recruiting everybody. Everybody's being recruited. Everybody's recruiting. Everybody's being recruited. And it's a really weird climate right now. It's way slower as we get into what is typically the beginning of spring buying. And it's really slow right now. And even maybe, some buyers that are ready and willing, there's either no inventory or they're freaked out by how much rates have jumped up right now. Obviously, what happened with rates is completely shut off the refi spigot unless you really, really have to take cash out. But even, I think a lot of those people, maybe going the home equity route or so they don't have to touch that first mortgage, to your point from earlier. But it's just a weird climate, right? I mean, good buddy of mine, he runs the fixed income securities desk for Jefferies, big investment firm in New York. And he's been screaming about Jerome Powell since about a month after the pandemic started. Just the loose money, giving PPP money to just every business in America and just handing out money and unemployment benefits beyond what a lot of people felt like they had to, and the impact that it would have on inflation and our economy in the medium to long term. And then Powell being really, just defiant that inflation was transitory as recently as 6 months ago. And now a little panicky. And I think that's freaking people out too. If it's Powell, if it's Lael Brainerd, if it's some of the other Fed governors that have come out and made comments, they all, the Fed has done a really good job historically over the years, not shocking the markets. You make that point all the time, right? They don't want to surprise anybody. They don't want to shock. But right now, their commentary based on past stances and just the tenor of it, it seems a little panicky, like, uh-oh.
Yeah, no, absolutely. And the question that I'm asked is, what are we going to do about it? What the fellow that who with Jefferies in New York, what is his rallying cry now? What's he saying? What's he doing with his money?
He's sitting on cash and drinking a lot.
You can't. I've tried that. In fact, I've tried it for many years, daily. And the problem now is that if you're sitting on cash, you're losing. I mean, pick your inflation rate, 3%, 5%, 8%. You're losing that in effect every year. So I'm out trying to scope some real estate, maybe in Cleveland. I could join a bowling league there in right like over the fence from you. Wouldn't that be something? But anyway, that aside, the sitting on cash right now, I don't know if that's quite the answer, but nonetheless, it's good to have Treasury tips, Treasury inflation protected securities, which, for your listeners they might want to check those out. But yeah, it's a real problem out there for investors, and it's a real problem for lenders. And what are lenders going to do about it? So I am continuing to hear cost-cutting measures, not necessarily layoffs, but trying to leverage their existing workforce. Certainly not replace anybody who leaves. Certainly not pay overtime. Remember when they were jacking the price up to stop the volume from coming through the door. And then, people were working 7 days a week, especially when the pandemic hit. There was nothing else to do. You may as well work. Now we have plenty of leisure time, and some people have more leisure time than they want. But companies are trying to figure out, okay, how are we going to, we know rates are going to go up more. What are we going to do about it? How are we going to train our workforce to deal with this? And, I mentioned in my commentary today, 2-1 buy downs. When was the last time you heard about 2-1 buy downs? So it's good to have your staff trained on higher interest rate products that you can offer, and or purchase products that can help first time home buyers, down payment assistance programs and so forth, high LTV programs. And, we'll see, last week we had Robert on and we talked about non-QM quite a bit. So I'm not going to beat that dog, but, non-QM is an option that many lenders are looking at in terms of trying to expand into those borrowers, self-employed borrowers or whatever it might be, and pick up some marginal business that way. But once again, we're dealing with a situation where there's no inventory for a lot of borrowers to buy. So even, Rich, if I were to offer you that 1% mortgage and I'm not going to underwrite your loan, go get them, you might have trouble finding a house to even borrow to buy. So it's a real mess out there, unfortunately.
This is the Rundown with Rob and Rich. I'm Rich Swerbinsky with the Mortgage Collaborative, joined as always by Rob Krisman. Any comments, questions, thoughts anybody has, feel free to drop them in the chat or the Q&A, and have a couple that have come in there that we'll get to momentarily. But yeah, a lot of good points. I think that you talk about products though, like, because right now we're 5.25, 5.3, 5.4 on a 30-year fixed rate. It makes an ARM very viable. Very viable. The problem, though, is 70% of the business in America, mortgage business, is being done by independent mortgage banks now. Secondary market, very, very still tepid and soft. If it's ARMs, go find me a 2-1 buy down product in the secondary market for an independent mortgage bank to originate and sell. You're not gonna find one. Home equity lending products, you're starting to see some of that pop up a little bit in the secondary market, but it's all got lots of asterisks on how you got to do it, and it's still very, very tough for an independent mortgage bank to do that type of business. But speaks to a point you made earlier. We've had a business climate that has been very favorable to independent mortgage banks for the last several years. You've seen that as the market share for independent mortgage banks has gone from about 30% to 70% over the course of the last 10 years. But now, as we move forward, a lot of advantages for the depositories, if it's HELOC lending, if it's the ability to do ARMs or buy downs or make sense products that they put in their portfolio. So you're seeing, I think, the business climate start to change a little bit as well right now. And but it's getting I don't think we always talk about it, right? At the end of the year, we start to talk about predictions for the coming year, and we make fun of all the economists, how they're wrong every year. And we talk ad nauseum about how no matter what you predict, you're going to be really, really wrong in this industry every year. And here we are again, almost 5.5% on a 30-year fixed rate. I mean, we were at 3% in like November. This is crazy.
Crazy. Yeah. So
home values, that my favorite topic, CoreLogic's latest report, February up another 2.2% from January. It's 26.4% annualized, up 20% this February versus last February. So you talk about, but investing in other things, like I don't have as much money as you. I wouldn't be investing in real estate right now.
Rich. I send out a free commentary. All right. So my assets are very limited.
And if you look, another interesting part about the appreciation numbers in this month, Florida and Arizona, 29% appreciation year over year. The 2 to 3 lowest states, New York and Illinois. So what you're seeing,
Manhattan.
People are flocking away from states with high tax, kind of, anti-business, not anti-business, high tax. Yeah.
Chicago, Illinois, not exactly the most, it's almost, you're just waiting for the next public official to be indicted in Illinois, right? I was talking to a friend of mine who is actually wealthy, and he and his wife bought a place in Hawaii a year ago. Just for your information, Rich, Hawaii is this island, one of the states, way like 3,000 miles off the coast of California.
In
Anyway,
America?
yeah, it's actually where my parents met. But well, that's a funny story over a barley pop sometime. But he bought a house a year ago on the island of Hawaii, not Oahu or Kauai. It has gone up 30%. It has gone up, he said, $1 million in a year. $1 million. And he and his wife are tired of, after a year of living there, are bored with island life and are looking actually to move back to Northern California. And he said, I can't afford to live where I used to live in Northern California. So they're going to, even despite that 30% increase in their house in Kona, he's trying to figure out what to do. He's it's like, he said, this is a great time to sell. I said, let me know when you're going to sell, Barry, because I'm a buyer.
Barry Habib, is that your friend?
What's that?
Barry Habib, is that your rich friend in Hawaii? No.
No. Where was I? Speaking of predictions, yeah, we returning to, who foresaw what we're seeing now. And you are seeing issues though with affordability. I've talked to some underwriters recently who are saying, sure, these families or these individuals are paying X amount in rent, but the affordability, if rates go up much higher, they're not going to be able to afford to buy the homes that they want to buy because of the monthly payment. And so we may bump up against a situation where housing prices don't go up. I don't think any of us really want housing prices to go up 20 or 30% a year. It's not healthy. So if we see some tempering of that increase in house price appreciation, I don't think that's such a bad thing, really. So
some signs that some help could be on the horizon. You look at some numbers that Redfin put out recently. 12% of homes for sale on their platform had a price drop during the last 4 weeks, ending just a few days ago. That's up
good.
From 9% from a year ago. You have listings in general up 8%. The most recent week that they measured, that's the first increase in the number of listings they've seen after 4 straight weeks of decline. So you're coming from a deep, dark place, but it seems like there's at least some signs that we're going to see at least this 26% annualized appreciation runaway rate start to slow down. It's got to slow down at some point, you would think, but you're starting to see some signs of it. I think a lot of it, though, is just because, rates too are playing a huge factor. If you've got a home for sale right now, you've got it priced high, because if not, you're an idiot. But you combine that with the fact that 30-year fixed rates they just keep going up. I think that's probably got a little part with, your some home listing price decreases statistics we've seen this last week.
Yeah, was that a question or just a statement? I think you're right. I think and I'm sure companies like United Wholesale are out there saying, how early can we raise our conforming loan amount, as they did last year. Remember that, before Thanksgiving, Fannie Mae and Freddie Mac, FHFA comes out with the loan amount right around Thanksgiving, and United Wholesale and several other companies followed. They announced early, I think in August or September, that they would start buying higher conforming loan amounts based on where they saw the FHFA numbers for appreciation. We're already seeing that. So I wouldn't be surprised as towards late summer that United Wholesale comes out with another headline grabbing move and raises their conforming loan amount for their brokers. So it's great PR. And I'll tell you, if this environment continues, they'll be safe in doing that. So yeah, go figure. All kinds of things going on out there.
Couple questions in the chat from our friend Tom Lamalfa. One, are you hearing about companies wanting to exit the business? Me personally, these last few weeks I have. I've heard more of that chatter inside and outside of our network. Lots of motivated buyers. I think you're going to see a lot of M&A. Just I think the worst fears of the independent mortgage bank that had some motivation to sell, maybe wanting to come into the spring buying season to see, like last year was way better year than anybody thought. Like if you would have sold it this time last year, it would have been stupid. So I think the mindset of a lot of business owners was, well, maybe I want to sell, but let's see how this year gets off to the start. And, a different start than last year, obviously. And then one asking, would you advise a 35-year-old friend of yours to buy a house right now? I absolutely would not. My thoughts on values, I think we're going to get, maybe not a bubbling, but a correction at some point here. And rates are astronomical. I mean, you'd be buying at the very, very tippy top of the interest rate and the value market. It seems like a stupid time to buy a house right now, but I thought it was a stupid time to buy my house 9 months ago, and I was wrong.
Yeah, you were wrong, Rich. So let's no, I'm not going to rub your face in that by any stretch. Regarding Tom's question about M&A, absolutely, Tom. I'm part of the Stratmore Group, and the Stratmore Group has a very active M&A practice, and the teeter-totter of buyers and sellers, whereas last year, a lot more buyers, few sellers, it's swung the other way. And you have a lot of people, Tom, I know you're only 45 years old, but a lot of people who are older than you who own a mortgage bank, do they really want to go through another business cycle? They've seen two of the best years that they have ever seen in their lives, in their business lives, in their mortgage lives. And now what's going to be the encore? Are they going to have to lay off a lot of their staff? Are they going to have to deal with warehouse banks who want to see profitability month after month, and it's hard to come by right now? Do they want to get into non-QM? Do they want to do some of the things that are going to be required to survive? And if they're 55, 60, 65, 70, do they really want to go through that again? So certainly small and mid-sized independent mortgage banks are looking at that. The owners are looking at that saying, is there a better way? Can we combine forces with our friends, in the other part of the state, and only have one accounting department and one capital markets department and one compliance department, and figure out how to make things more efficient? I am definitely seeing M&A possibilities increase just based on what's going on with Stratmore. And then the second thing, Rich, you talked about with regard to advising a 35-year-old to buy a house or not, I probably still would. I mean, so you have a 35-year-old potential first-time home buyer. He and his wife, or she and her husband, have saved up X amount of money for down payment. They probably both have sets of parents who are probably seen their wealth increase. They're looking at that saying, we need a house, we've got a child or two, and what are we going to do about this? Do we want to live in an apartment? And I've made the point in the past that regardless of what happens in Ukraine or wherever, the desire to own a home for a lot of people is still paramount. And so lenders, the loan officers that I speak to, are still seeing people out there who want to buy homes, regardless of interest rates and regardless of appreciation, because the alternative, renting or living in their parents' basement, or being in that apartment, or renting a house where the landlord is jacking up the rent every month, just is not something they want to continue to be subjected to. So I still see a drive for home ownership.
Yeah, we'll see. I bought my first house in 2008, in the winter of 2008, for $250,000. 4 years later, it was worth like 205. I feel like we're in one of those climates right now, but who knows? We'll see. I'm wrong more than I'm right. And some other news this week, Rob. UBS Financial, one of the biggest financial firms in the world, their chief investment officer made some headlines this week. It's about a few days ago when 30-year fixed rates were about 5%, and said 5.75 30-year fixed rate will cause a housing bubble. Since she made those comments, we're now like over halfway there from 5%. Just and citing a lot of statistics that I won't get into, but starting to hear more of that. Dallas Federal Reserve came out, and both people went out of their way to say this would not be like '08. There's underlying fundamentals that are much stronger than the meltdown, but it was noteworthy to me.
Absolutely. I know I'm not going to disagree with any of that, but you're right. The borrowers who have borrowed money to buy these homes are much better credit shape than 15 years ago. You have a situation where, like we've talked about, the supply and the demand just, I don't know, the housing stock is still there. Lenders are still optimistic about some of their prospects to lend money, assuming people can buy houses. But yeah, it's an interesting time, and the problem with bubbles is, I'm going to start using overused terms. The problem is with bubbles is they pop, and you have to ask yourself, are we in a bubble that is going to pop, or are we in a market that might correct? And that's the term I'm using a little bit more of. Might there be a correction at some point? And a correction might be, gosh, instead of going up 25% a year, maybe housing prices are only going up 5 or 10% a year. I just don't see them plummeting. Just like I never saw, in 2008, 2009, people were out there talking about this refi, or I'm sorry, this foreclosure tidal wave, and I'm sitting there thinking, I don't see a foreclosure tidal wave. I think the inventory will get soaked up by individuals buying second or third homes, non-owner occupieds, but also corporations stepping in and buying up properties. I just don't see a bubble popping and bursting. I see possibility of a correction.
I'm with you. I mean, I don't see a bubble popping. I think there's so much, just a shadow inventory. There's so much housing demand to buy properties out there, from people that are actively looking and there's nothing, to people that need something to change rates or affordability. I think in the pandemic, I think just had a huge impact on just demand for housing in America in general. So I do think we're going to get correction on values starting probably later this year. That'll go for a few years, but that it'll be not a bubble popping, but like a pinhole leak for a few years. So, Rob, the CFPB posted.
Oh my gosh,
This
Rich,
was interesting.
you saved the CFPB for the tail end of the show. I thought you were going to say, Rob, what are you doing this weekend? Instead,
I got to bring this up because it was somebody on our staff forwarded this to me. I didn't even see this. It didn't make the news headlines. But the CFPB posted Rohit Chopra's opening remarks they created a community bank and credit union advisory council, which I think is great. And but anyway, his comments were basically the major core system providers for financial institutions like Fiserv, Jack Henry. There's 4 of them that have like 80% market share. And they've just been raising their prices because they have market share monopoly. And it's so painful for a community bank to change core systems. And they've just been, according to Chopra, bleeding community banks and credit unions dry on price increases. And it's worth Googling and reading, because they posted this publicly. He basically said he's coming for the large, the large core system providers for financial institutions, and it's good for community banks and credit unions. That's my background, and I know that pain they're going through. But on the other hand, you could say it's concerning, how willing he is to insert himself into the free market business process. So,
yeah, free market business process. I agree 100% on that. The CFPB is definitely, and I apologize for the wind noise. The CFPB is definitely broadening its scope, and we saw that during the early years with Richard Cordray as he was establishing the CFPB and their range of power and their authority, and we are seeing a renewed effort in going on with the current administration. So, yeah, the at what point do they stop? And at what point do you say, well, companies will charge what the market will bear, but who is the CFPB to come in and regulate pricing like that? I disagree, but they're going to do what they're going to do.
Yes. Only two other things I wanted to note that I thought were newsworthy. Walt Disney World came out a couple of days ago and said they plan to build 1,300 affordable housing units in Orlando. We've talked in the past about that could be part of the affordable housing solution. These big corporations, Apple and a couple others, did it in your neck of the woods out west in California, using some of these massive profits they're making to invest in some affordable housing units in and around there. I thought that was newsworthy. And then Better.com just can't stay out of the news. This is a case study in just how not to run a business. Honestly, it's comical at this point. Now they're evidently begging their employees to quit. So you can't make this up. It's almost as if they're trying to take the company down. There's been movies and spoofs about that. There's got to be like a mole inside the company that's just trying to take this company down. I can think of no other explanation for the comedy of errors these last several months.
And I don't mean to laugh at anybody's misfortune. And in fact, I've got a site where people can post their resumes for free, and I'll put that out there again Monday, because nobody wants to laugh at somebody who loses their job. But I don't understand this whole Better.com thing. It's probably a lawsuit waiting to happen for some class action situation. Yeah, I wouldn't. It's just bad. There's ways to deal with loss there are ways. There's a philosophy which I believe in that when you bring somebody on, if you let them go, you go through the same care and feeding and empathy as you would when you brought them on board. It's pretty straightforward. But Better.com is, I don't know what the heck's going on there. It's nuts.
All right, that's all I have. So anything else you got? Any weekend plans? What are you doing in that field? You still never answered that.
I'm feeling the ticks. The ticks are never mind. Where was I? Oh, I got to play some hoops tomorrow morning. Maybe play some tennis. Maybe do some social stuff. I don't know. What are you up to? Watching the Masters?
Yeah, my daughter's got a dance competition I got to go to shortly after this tonight. And then I'm taking my son on some college. My son's finishing up his junior year of high school and a lot smarter than I ever was. Taking him to go visit Case Western here in Cleveland and the Ohio State University, which I'd love to see him go there. Doing some college visits tomorrow. And then, just locking in Sunday in front of a TV and watching the Masters.
There are institutions of higher learning west of the Mississippi that he may want to look at.
Yeah, well, yeah. I mean, I would love to see him stay in Ohio because college is. It's amazing how expensive college is. How has the price of college outpaced even today's inflation? Like when I graduated from high school in 1994. I didn't go to college, but I could have went to college for like $8,000 a year, a good school back in 94. Ohio State, which is a great school, but even shitty schools are like $25,000 a year. It's crazy.
Yeah. So. Yeah. Actually, send him to trade school.
That would be cheaper. Yeah. The country needs it too. It's skilled labor is one of the things that's been lost in the lurch in America these last couple decades. So,
well, hey, have a great weekend. I hope you enjoy it.
Absolutely, and enjoy the weekend yourself, Rob. To our audience, thanks as always for wrapping up the week with us. We are here every Friday, 3 p.m. Eastern with the rundown. Please subscribe to us, the podcast version, where we get the most consummation of this. TMC Connect on any of the podcast platforms and subscribe, and this will be put into your feed. So, but till next Friday, Rob, have a great weekend, bud.
See you later.
Take care.